Patrick?
Okay, talk a little bit about for us assets. How many buckets of assets are out there a person probably has, and explain that to us a little bit.
Okay. I'll tell you there's basically three different kinds of assets. Taxable. And what do we mean by taxable? That which is, you're going to get a 1099 for it, which is the tax form that says we paid you some interest. That would be bank accounts, CDs. You know what they are, right? Certificates of disappointment. Okay. Money market, brokerage account, stocks and bonds. So I'm going to call this, and why is this stuff pretty good? It's liquid, right? I can get to it. Most financial planners don't agree on a lot of things, but they agree on this one thing, that you should have about 6 months of income, 6 months of expenses for income in this account. Anything past here, we need to shift. Now we have tax deferred. Tax deferred would be 401k, IRA, TSP, which is the government's version of an IRA, 403b, anything that's kind of you either put money away and you haven't paid the taxes on it yet. Is it good to have $1 million in this account? You'd think so, wouldn't you? We don't want any more in this account than when you have to start drawing money out, that your required minimum distribution happens to equal the standard deduction. When you are 70 and a half, and you have to start drawing from that today, this year, you get about a $26,000 standard deduction. How many of you have heard that we're going to be in a lower tax bracket when we're retired? Oh yeah, we've all heard that, haven't we? Are we? Well, there's a couple things. We don't have kids. Most of the time our mortgage is paid for. We may not even have large charitable deductions because we're donating our time to our charity or our church. So we're now taking a standard deduction. We want the required minimum distribution to equal this number. Anything past there is not good. If the RMD, required minimum distribution, is $26,000 and your standard deduction is $26,000, what's the taxes on that money? 0, right? Okay, that's what we want. 0 taxes. And then we want an account over here called tax-free money. In order for something to be completely income tax-free, it has to meet several requirements. One, it has to be federal income tax-free. The second, it has to be state income tax-free. We've heard that municipal bonds are tax-free. Have you heard that? They're federally tax-free. Are they state income tax-free? Depends on the state of the bond. If I buy, I don't know why I would, but Illinois bonds, they are free of federal income tax, but I have to pay state income tax because it's not my state. But if I buy Louisiana bonds, I don't have to pay Louisiana income tax on that. But can I still be subject to taxation on those bonds? Yes. Because if interest rates change and the value of my bond goes up, I put $10,000 in and now it's worth 11, even though it's paying me whatever, and I sell it, I now have to pay capital gains on the difference. So in order to be truly tax-free, it has to be free from federal income tax, state income tax, and long-term capital gains tax. Ideally, Social Security fits in that category, okay? We want Social Security to be income tax-free. If you put money into a Roth IRA, or if your employer had the option in your 401k, a Roth option, of putting the money in after tax, I'm going to tell you that was a good move, and you should do that. The other is Roth Conversions. And that's what I did in 2011 and 12. I said, I'll just pay the taxes here. Ladies and gentlemen, the taxes are on sale today. Do you think taxes are going down anymore? No. Good night. We're in $22 trillion in debt and spending $1 trillion more than we bring in. Taxes have got to go up. And Colin said earlier that politicians want to kick the tax thing down, the can down the road, because no one wants to be elected by saying, vote for me, I'll take away your benefits and raise your taxes. But ladies and gentlemen, we cannot continue on the path that we're doing. Taxes are on sale today. Now there's another product out there called a life insurance retirement plan. And when I came in the business 47 years ago, there was two kinds of insurance. It was whole life and it was term. That was pretty much it. Okay, variations. We had endowments, and that was it. Then it came universal life and variable, and all confusing conglomeration of a lot of different variations of it. But today, they have different products in the marketplace that we can convert this money into this money. And why would we do that? There's a couple points. One is we take some of the money out of here that still maintains this this number low. This has tax-free death benefit to our family. I just made a calculation for someone today, had a large 401k. I said, why don't we take some of the 401k and turn it into this and have money available to the family to pay the taxes on the balance of it. And that way they'll get the whole thing tax-free. The second thing it has is long-term care benefit. There's a couple ways to buy long-term care, all of which are expensive. But if you do it through this fashion, if you don't die, but you have to go to a nursing home, we can draw from the death benefit to pay for nursing home care. But let's keep you healthy, let's keep you alive, and now a couple years down the road, we say, now I want to draw from that pile of money. The money that you have coming out is income tax free. And this is under section 7702 of the Internal Revenue Code. I'll say 7702, anyway. And that says that we can do these things, have these tax-free benefits for ourselves and our family. Does that make sense to you?